All right, so Joseph, thank you again for joining us for another market update video. Got a couple key things we wanted to talk about today, but I think we'll first just dive into just talking about the overall market cap weighting right now. I think in the news it's been Magnificent Seven, Magnificent Seven, all of 2023. Seven stocks driving basically 95% of the returns. Seemingly Tesla dropped off of that in the last quarter. And we were left with six, and now there's seemingly four. So talk about I guess what we're seeing there and what those names are and why ultimately they're driving the majority of the market returns.
Yeah, sure. So if you kind of even back it up to whatever the acronym is that we're talking about, the whole point is that there is increasing concentration within the indexes that we follow. So the S&P 500 is obviously kind of the main index that everyone sees and watches on TV, and it's kind of the proxy for what equity markets as a whole are doing. S&P 500 is market cap weighted, which means the bigger the company is in the index, the more pull it has on the total return of the index. And over the years, those biggest companies have grown and have become a bigger part of the total return of what you see in the S&P 500. So if you take the top 5 names in the S&P 500, that's Apple, Microsoft, it's now NVIDIA, you have Google and Amazon in there. They account for just over 25% of the total index composition. You have to go back to 1964 to where you had more concentration in the index. Back then it was AT&T, it was General Motors, Exxon, IBM, Texaco. So it's changed quite a bit. But the point being that when you have a situation like this, it can really be good or bad. If those companies continue to do well, it's obviously going to drive things higher. If they hit a stumbling block, they're going to have a bigger influence on what the index returns are. So as Eric mentioned, last year we were focused on these big 7 names. This year, Apple, Google, Tesla have struggled a bit. Tesla's started struggling into 2023. Apple and Google, especially Apple, has had a little bit of a rocky start here year to date. So you've really had 4 names holding up the index in a big way. Meta, Facebook, you got Amazon, NVIDIA just continues to kill it. And then finally, Microsoft. So those 4 names have made up 58% of the return in the S&P year to date. So that concentration continues. You could say it's a good thing or a bad thing, but it's helpful to be aware that dynamic is happening.
Yeah, so typically we don't see that big of a weighting to the top. There's always a weighting. Larger companies make up majority of the index because it's market cap weighted, like you said. But it seems like this is seemingly getting to an unhealthy level. And if things were to start to crack, then and those companies started to sell, then that could really cause some issues to the downside, right?
Sure. Yeah. I mean, anytime you have concentration risk, just like we think about a diversified equity portfolio, you're going to be pulled one way or another based on how your bigger weightings are doing. So you think you own a 500 company basket of stocks in the S&P 500, you technically do, but you really don't in terms of the influence of those names. So, we continue to keep an eye on those.
Got it. All right. And then coming into, I guess, just taking a look at Q4 earnings, we're right at the tail end of the season, and just, I guess, give us a pulse on what we saw with Q4 and how those numbers came in.
Yeah, so I think by most accounts, the earnings season for the fourth quarter of 2023 was considered pretty strong. So I think 75% of companies in the S&P 500 were essentially done at this point. Almost, I think all but about 15 names have reported. But of those that have reported, I think 75% beat their analyst earnings expectations. That's more than if you take the average going back to the great financial crisis, that's been 72%. So you can see that at the margin, companies typically beat earnings, but this last quarter was a higher beat rate than we've seen historically. We're looking at operated earnings up year over year to the tune of a little over 7%. If you take net income at the EPS level, it's up a little over 9%. What's interesting though is that although the earnings beat was pretty sizable, if you go back to expectations at the beginning of the quarter, so October 1st, they really came in right in line where analysts were signaling at that point. Actually, if you look at EPS numbers, earnings per share, they actually came in a little bit below where they were at October 1st. That's not out of the norm. You usually see this phenomenon where during the quarter that's happening, analysts revise numbers lower. Companies then end up kind of they essentially sandbag their expectations and then end up beating that. I think one thing that's of note this time, though, is that even though earnings came in roughly where they were expected when the quarter began, the stock market's up. S&P 500 is up 20% since October 1st. So you have a situation where you could argue earnings really didn't outperform. They really kind of came in line, and yet the market's been kind of racing higher. So again, something we're watching when it comes to how the market's valued, how they're perceiving earnings, and then how that's going to play out over the next year.
Got it. So nothing exceptionally of note, but it's not necessarily driving markets higher, not necessarily driving markets lower. It's just kind of basically in line with expectations. So I guess also just turning back to the S&P overall, talk to me a little bit about its composition and how that ultimately has changed over time in terms, not market cap weighted, but sector weights.
Yeah, sure. So, when you think about a lot of our inbound questions are, this market's highly valued, the PE multiple's high, the valuation's high. We're trading at about 21 times forward earnings on the S&P 500. That means for the year 2024, the expected earnings as a divisor into price is roughly 21 times. So, historical averages, that's closer to 15, 16, 17 times. So you look at that and you say, okay, that's pretty rich. There's a lot of optimism baked into the market. And on one hand, that's definitely true. On the other hand, it's worth noting that the S&P 500 is not static over time. You look back, even just 15 or so years ago, you had an energy sector that was roughly rivaled the size of the tech sector. And now that doesn't look anything like that. So if you look at, I guess, what we would consider more innovative type of sectors, so tech, communication services, X, kind of the telecom, the AT&Ts, the Verizons, and you think about healthcare, those are more innovative, more asset-light type of sectors that tend to trade at a higher multiple because of the composition of their business. If you go back to 1980, those type of companies made up 14% of the index. Now they make up 49%. So there's at least a case to be made that it's not really fair to compare a PE multiple 40, 50 years ago to what it is now, because you're not really making a apples to apples comparison in terms of what's making up that index. Now, you could make the flip side of the argument and say, there were companies 100 years ago or whatever that might be categorized today as less innovative, and more kind of, like a consumer discretionary type company like Ford, for example. Ford today trades at a very low multiple. Not seen as doing much on from an innovative standpoint like an Nvidia is or a Microsoft, and yet think about a Ford 100 years ago. They essentially invented kind of the modern assembly line and how vehicles are made at scale. Extremely innovative. So I think you can take both sides of this argument. It's just kind of important to understand that S&P 500 today does not look like it did 50 years ago. Therefore, to say this valuation should be the same, it might get you into trouble thinking that way.
Okay, so historical context is very important when looking at composition and all things is in that matter. Like the basket of goods in the CPI basket has changed over time, right? And so
Right.
You can't look at that as an absolute reading as well. So I guess I want to just round this out with a conversation around AI, and I anticipate we're going to be continually talking about this for some time now. But I guess just Give me a little bit of insight into how you're viewing this in terms of, a secular boom, anything that we've seen in history is similar to this, or is it here to stay? I guess just touch on that, and we'll kind of keep a pulse on it, for the months and quarters to come as well.
Yeah, so artificial intelligence, all the rage. It's this type of technology has been around for years and years, but it was really you go back last year when OpenAI launched the latest version of ChatGPT, kind of at scale. The consumer started seeing the capabilities of this technology, and that really triggered kind of the boom in this modern AI type of chase. And I read a really great analogy that I tend to agree with how this iteration of technology is, and this boom is playing out versus the West Coast gold rush of the mid 1800s. So if you think about when gold was first discovered in California, the initial beneficiaries of that were less so the prospectors and more the suppliers of the equipment needed in order to mine gold. So you think about shovels and picks. They were the big winners up front because everyone needed that gear in order to try to make their fortune. So if you think about the equivalent of that today, you think of semiconductors and you think of cloud computing space. And when you think of semiconductors, there is no bigger name than NVIDIA. And you see what that stock has done over the last couple of years. It's gone essentially parabolic up. And what's amazing is that that is really not exactly a bubble type of action. If you look at expectations for their future earnings, they're justifying the type of move we see in the stock. In fact, the stock has actually gotten cheaper on a P value versus 2 years ago, where it was nearly 60 times, and now it's in the mid to low 30 times P ratio. So those are kind of the initial beneficiaries of this boom, the people providing the picks and shovels in order to participate in this. If it's going to have longevity, if it's going to broaden out, then essentially the companies that are benefiting from the pick and shovel type of, and that's, like an NVIDIA on the semiconductors, on cloud computing, it's Amazon, it's Microsoft, it's Google. You've seen all these stocks rise, really big since kind of this ChatGPT phenomenon came out. If that's going to broaden out to the greater market, then we've got to see kind of AI applications outside of the Magnificent Seven into the 493 other companies in the index. So how can AI make an industrial type of company, a finance company, a consumer discretionary company? How can AI make those more profitable? How can they help drive revenue? How can they increase profit margins? And to the extent that can happen, they're essentially the prospectors in this gold rush. The suppliers, the pick and shovels, they need the prospectors. They need them to benefit, because if they're not finding that gold, they're not going to keep buying picks and shovels, right? You're not going to have more people buying picks and shovels. So there is a sense in which this craze over semiconductors, over cloud computing, it needs broader application of AI in order to sustain that move. And that's not something that's going to run out of gas tomorrow. It's probably not going to run out of gas this year. But it will in future years if you don't have broader adaption of AI at really just the more mundane level. Again, the other 493 names in the S&P 500. So I really like that analogy. I think it speaks to what we've seen so far, who's been the winners, and then where it needs to go if it really is going to prove to be this technology that really does shape kind of the corporate profile of how businesses interact, generate revenue, and ultimately make profits.
Yeah. I like that analogy a lot. I've always thought like the first degree of thinking are those data centers, the cloud computing, the chip providers, and then the second degree of thinking, maybe we're early, but those are these 493 other companies, right, that are bogged down with inefficiencies. They don't have the capital to expand their operations, but maybe with this technology at a much lower cost can start to increase their ultimately their revenue and cut costs over time. And so that's what I always thought. This, like, yes, NVIDIA, Microsoft, Amazon, these are going to be direct beneficiaries, but then it's kind of yet to be seen what those other companies are and how they're going to be able to innovate and multiply over time. And so, I think it's an exciting time. There's with anything that with this much excitement, there's a lot of unnecessary hype as well. So, that's why we're going to be monitoring this and seeing how it ultimately plays out over time. But I think it's exciting, and I don't think it's an ultimately, a bubble at this point. There's true application. There's a lot of money being spent in this space, and rightly so at this point, but yet to truly be seen. So,
Yeah. Good
all right,
summary.
Joseph, we'll any last words or anything? I think today was a great conversation, and look forward to the next one. I appreciate you being on with us.
Yeah, my pleasure.